Good afternoon, class. Welcome to Metric Hub, and thank you so much for connecting and tuning on. Today we are meeting basically to work on revision of term 1. We have a paper that I've just pasted on board here. Please note that you are connected to Metric Hub right now. We have got questions that we are going to respond to just right now. And one other thing is that before we answer questions, class, please note that you always have to read instructions, follow instructions in the paper. That is quite very necessary and compulsory that you read the instructions and answer the questions according to the instructions that are given in each case. So section A is compulsory. We need to answer those questions there. First question reads, injections in an economy include dash. Injections in an economy, they include, we are saying in an economy, we are talking about activities that injections, we look at activities that adds money into the economy, that generates income to the economy. So what happens is that we are talking about all activities whereby income is improved or it is earned. We are talking about earnings that are as a result of those activities. We need to earn money. So what happens is we must look at activities such as we look at investment, government expenditure, and exports. Exports are a good source of injection. We earn foreign currency. Investment, it can be foreign direct investment and also government expenditure, government supporting its citizens or its people. It forms a basis of injection. So we are saying injections or activities that earns income to the economy or that boost income to the economy. We are saying these are called injections. So it is B, injections, investments, government expenditure, and also exports. An increase in the level of economic activity is a characteristic of dash. An activity in the level of economic activity, it is a characteristic of, we are looking at a business cycle. So we are saying when economic activity increases, it is a characteristic of prosperity. Where we are saying on the business cycle, we are saying during prosperity, economic activities increases. So we are having an increase in consumer spending, we are having an increase in investment, employment, and all those. So every positive activity in the economy, basically what it does, it boosts the economic functioning. It actually generates uh, positivity in the economy. So these are characteristics that are experienced during the prosperity phase. And when a country can produce a product at a lower opportunity cost than any other country, it is known as disadvantage. Uh, I just want you to know that this is actually known as, before even go to the answer, we are saying a situation where countries can produce at a better opportunity cost than the other country. It is called comparative. We are looking at the different countries and their advantages. So it is called comparative advantage. It is comparative advantage, which is to say that it is what it is A. It is a comparative advantage. It is called comparative advantage, meaning to say the answer is what is A. As we look on this question, it is a comparative advantage. And then the exchange rate system that is determined by market forces, demand and supply, is known as, we are saying in an economy, we have got exchange systems, which is, we are saying it can be free floating, it can be managed, and so forth. So if it is an exchange system that is based on market forces. The market forces, we talk about the forces of demand and supply. So that is to identify that it is called free floating. Free floating identifies an exchange system where government intervention is not involved. We don't have government control. And then managed, of course, is the one that is mechanized, which is because of some determinants that are fixed with regards to the economic conditions. But demand and supply are forces that actually balances the exchange rate in a free market or in a free floating exchange rate system. Number 5, a document that is presented in October to inform Parliament of changes in the budget since February is known as, we are saying when you look at this, it is called a medium-term budget. It is called a medium-term budget policy statement, medium-term, which is presented in October to inform Parliament of changes in the budget since February. So it is called a medium-term budget statement, which is also we are saying it's a medium-term budget policy statement. It tries to review and evaluate the changes in the budget since February. So it is that document which is called medium-term budget statement, budget policy statement. And then we need to match the terms in we have to choose the correct answer from the following, and then we write only the letter next to the question number. So a factor market, it has to look at we are saying factor market, it looks at services of factors of production are bought and sold. In a factor market, services of the factors, the services of factors of production are bought and sold, which you need to see that we can understand that is what, that is E. We are saying it is a factor market. It identifies services or factors of production are bought and sold in there. And then budget deficit, it actually identifies it is a situation where expenditure exceeds revenue. Budget deficit, it means to say that the expenses are above the income or the revenue that the government is making. It can be a government or it can be any organization. So that is what, that is A. And then monetary policy committee, the monetary policy committee, what they do is they manipulate the instruments of the monetary policy to balance the state of the economy, which we need to understand that they are there to interrogate. We are saying they manipulate the instruments of the monetary policy. We are saying these are instruments which are used to regulate demand and supply, which at the end of the day, it is set as tools towards controlling of inflation. And number 2.1, 1.24, the quadriff cycles. The quadriff cycles, it actually identifies that we can identify it as lasting for 50 years and more. It is cycles that last for 50 years and more, which we say that it is what? It is G. And then 1.25, trade balance is the difference between the total income received, from exports and also versus the payments made for imports. So income from exports versus the payments or the expenses from imports, we call that budget. We call that trade balance. Which can also be defined by B. It is B, the difference between total income received from exports and payments made for the imports. So what we receive must be more than what we pay out. So what we need to understand is that injections must be more than leakage, because imports is a leakage and exports is an injection. So a health economy, which we can say good terms of trade, it is actually provisioned by having more exports than imports. So the answer is what is B. And then gross national product, it can identify value of economic goods and services produced by permanent residents of a country inside and outside the borders of a country. So gross national product, it is uh, a it is actually an evaluation. We are saying it assesses the performance of the economy in terms of the value of economic goods and services that are produced by permanent residents of a country inside and outside the boundaries or the borders of a country, which is to mean to say the answer is D. So as you can see, I'm saying this is one of the questions which we also need to understand that it's quite possible for us to get all the marks on it. The next question is saying give one term for each of the following descriptions. Write only the term next to the question number. So we don't use acronyms or abbreviation in terms of this. So now, a phenomenon where an initial increase a phenomenon whereby an initial increase in the rate of spending will result to a more than proportionate increase in income. I'm sure that we have talked about the multiplier effect to say that initial increase in we are saying initial increase in the rate of spending, it is actually resulting in more than proportionate increase in income. So what we understand is that it's called the multiplier effect. The multiplier effect, we have also managed to explain this graphically, which we have identified that the multiplier effect can also be assessed through a graph or through uh, some some graphical analysis. So when an initial increase in rate of spending actually is more than the proportionate increase in income, to say that the income that we receive is actually bigger than what we have spent. So it called that multiplier effect. The point where economic contraction is at its lowest, we call that that point when the economic contraction is at its lowest. It is defined as what we are saying. That is defined as the trough. I've mentioned that the lowest point of a business cycle, it is called the trophy. It is called the trophy, which we are saying it can be seen when we look at a business cycle. This is identified as the lowest point, which we call the trophy. And then we have got its highest level, which we call the peak. So the lowest point of economic performance is the trophy, and the highest is the peak, which can also be seen in a business cycle. And then we can also have the trend line and whatever other features of a business cycle that we might need to uh, look at and understand. But what I want you to know is that when we are looking at business cycle, the lowest point, the point of economic contraction, which is at its lowest, is the trophy. And then administered reduction in the exchange of a currency against another currency under fixed exchange rate system. We are saying it is controlled, it is mechanized. So when it is administered reduction, it means that the exchange of a currency against another currency under fixed exchange rate system, we call that devaluation. Devaluation is done as a deliberate reduction in exchange rate of a currency against another currency under fixed exchange rate system. These are regulatory systems or practices that are put in place in regards to control economic performances within a country and so forth. So what we are saying is called devaluation. The equal redistribution of income and wealth, we saw that it is defined as economic, we say that it is called economic equity. Equity means fairness, equally economic equity, saying that is the equal redistribution of income and wealth, to say that the wealth of the country is accessible to all other people or everybody within the country without any segregative practices. So we call that economic equity without any form of discrimination. We want to answer question 2.11. Question 2.11, it is actually given that question 2.11 is asking give any two examples of state-owned enterprises. State-owned enterprises, SOEs. We are saying these we can give examples. We can say ESCOM is a good example as a state-owned. We can talk about South African Broadcasting Corporation, South African Broadcasting Corporation. We are saying it is state-owned. We have also examples such as Transnet. It's another typical example that we can give as to say that these are state-owned. I guess also, which is one of the most commonest one, is the South African Airways. South African Airways, it is also the most commonest and known example of state-owned enterprises. They are owned and they are run by the state. We can talk about Sandam also. We talk about the railway system. It is also run through the state. And what does the South African society stand to benefit from nationalization? Nationalization, we are saying that instead of certain businesses and practices being under private ownership, they are nationalized, as to say they are turned into state properties and assets. So we are saying, how does that benefit the South African society? One, we are saying the inequality gap will be minimized as much as possible, because of the government will be in control. For example, we talk about schools would have equal resources. We are saying it reduces inequality gaps amongst the citizens, since the government will be in control. Inequality gaps are reduced because the government will be in control of such. So we are saying these kind of nationalized properties and assets will benefit by having more resources, which can also help in terms of saving the South African society. We can also talk about all the wealth of the country will be shared amongst all the citizens. All wealthy will be shared amongst the citizens. We can also benefit in terms of even improvement in infrastructure, government spending, government funding on such services or functions which are now run through the national budget. They tend to provide the best because otherwise the government has got the capacity to ensure that those services are readily available, and we are given exchange rate, as to say demand and supply of exchange rate that is given there, and quantity of dollars that are there. So what happens here is that demand and supply, we are seeing a decrease in demand, which actually moved from, we are saying, from D1 to D. We are saying it actually increased from D to D1. And then what we need to understand is that there is such a change. So we want to see the questions. Identify the original price of rand to a dollar. The original price of the rand to a dollar, we need to look on the graph there. The original price of the rand to a dollar, we are saying it is the original is from the first one. This is the original demand. This is our original demand is here. So now it actually increased, then it migrated to D1. So the original demand for the rand against a dollar, we talk about that is 10 rand. Rand per dollar, it was it is 10 rand. That is 10 rand, which we can see from the graph there. What happens to the value of a rand if the demand curve shifts from DD to D1? We are saying what happens to the value of the rand if the demand curve shifts from D to D1. What we need to understand is that what happens is that the value of the rand actually, we are saying the value of the rand, it actually depreciates. It is the value of the rand, it actually depreciates. What we are looking at is a situation to say that we were buying a dollar with a 10 rand, but now we are saying we are buying a dollar with a 12 rand. So that is to say that we are using more rands to buy less. So what happens is that it is called depreciation. We are seeing a decrease in the purchasing power of a currency against another currency. We call that depreciation. So now we are saying the value of the rand depreciates. Value of the rand, it depreciates. That is because we are saying initially we were buying a dollar with $1 with a 10 rand, but now if when it moves to D1, we have got an increase of something like, to say initially it was 10, we are now buying a dollar with a 12 rand, which means to say we need more rands to buy $1. That is a depreciation experience or scenario that we need to understand. And then describe managed floating exchange rates. Managed floating exchange rate, it is actually, we need to understand that managed exchange rate, it is this is a type of exchange rate system. It's another type, a type of exchange rate system. This is a type of an exchange rate system where government will intervene when necessary. We are saying where government actually it intervenes, where government intervene when necessary, where government, we are saying it regulates it controls necessary the buying and selling of foreign currency, that is to stabilize the currency. It when necessary, what it does is it intervenes in the buying, it intervenes in the buying and selling uh, of foreign currency in order to stabilize the currency. They want to stabilize the currency. The currency is stabilized through managed. It is managed because the government is also controlling, it is mobilizing, it is regulating the buying and selling of foreign currency in order to stabilize, the buying and selling of what, or I mean, in order to stabilize the currency. So we call that a managed floating exchange rate. And then we have got an explain the reason for shift of D to D1. This we are saying what can cause explain the we are saying explain the reason for the shift of D to D1. This can be because of we are saying this shift is because of an increase in what, in imports to South African citizens, which we can also say that it actually demands more dollars because they need to what, to pay for American goods. You see, what we are looking at here is that as you look at this graph to say what might cause the change from D to D1 here, which we can see that the value of the rand, it actually decreases. The rand depreciates. We are saying the original, the value, the original demand was 10 rand. We are saying 10 rand is equals to a dollar, is equals to a US dollar. But now we have got 12 rand is equals to what? Is equals again to a US dollar. So what we are saying is what causes the shift of this? This is because an increase in what? In imports in South Africa. This is due to an increase in imports into South Africa. So what happens is that we are saying imports into South Africa. So South African citizens demand more dollars into South African citizens. They demand more dollars. They are demanding more dollars because they actually need to pay for American goods, which are in dollars. They demand more dollars in order to pay for American goods being sold in dollars. So what happens is that as the demand for American dollar increases, we are saying we have got such a shift because the people, the South Africans or South Africans are really in need of the dollar in order for them to make purchase, in order for them to buy. So into South African citizens or into South African market where more dollars are needed to pay for American goods being sold in dollars. And then analyze the impact of appreciating rand to outbound tourists. That is to say that we are saying if the rand, if there is an increase in the value of a dollar, of a rand, appreciation. This is, for example, we can give an example, e.g., we are saying 9 rand is equals to a dollar. That is an example of appreciation versus the previous scenario where we are saying we are using less of South African currency to buy otherwise the same amount of dollars. Instead of using 10 rand, we are using 9 rand. So this is an example of what? Of appreciation. That is an example of appreciation. So now, how does it affect uh, outbound tourists? So there will be more tourists traveling abroad because goods and services, we are saying goods and services will be much affordable as they go out because they need less of South African rand to buy more dollars. So outbound, we are talking about the tourists who are moving or traveling out of South Africa to go to America. So we are saying one, more tourists will travel to America since it will be cheap for them, cheap to buy more US dollars. It will be cheap for them to buy more dollars. So more people will travel to America because with their less money in South Africa, they are able to buy more of the what? Of the US dollar. So a stronger rand means that the South African tourists can buy more also foreign currency, which increase the spending power abroad. South African tourists can buy more abroad and results in more spending power, results in more spending power so because the rand has gained appreciation, we are talking about gaining of the rand to say that we are buying more dollars with less South African rands. So that can also cause more people to travel abroad because they are able to benefit and enjoy the value of their money. And then we can talk about that can also it can also cause uncertainty and instability in foreign exchange market. We might have such uncertainty and instability in foreign exchange market where people are not quite aware and are not quite sure of what has to be done. So that can also be another scenario that we can talk about. We want to look at question next, which is national accounts for South Africa at current prices. We are given the national compensation of employees in 2021. We are saying 2021 billion rands that are given here. So gross value added at factor cost 5,553. Gross value added at basic prices given as X or A, the gross domestic product at market prices given also in these various figures that are given on the table there. So now the question is saying identify the method used to calculate the gross domestic product in the table above. So we are saying the method that is used here, as you can see, gross value added basic prices. We are saying we have got we are talking about money that has been made, and then we are talking about money that has been made, which we look at income. So we are saying this is called GDP through an income method. This is called an income method. This is called income method. And then name one example of taxes on products. Taxes on products. Example of taxes on products. We can talk about we are saying products when they are sold. We have got value added tax, value added tax, mostly known as VAT, quite known as VAT, which we are saying that it is levied on products and consumers. It is applicable to all consumers. And then we are saying we also have import duties. Import duties, when goods are entering in the country, there is a charge that is levied on them in order sometimes to protect local markets. We are saying we can have import duty, which we can also call import tariffs. Or we can also talk about we can also talk of exercise duty. Exercise duty, which I want you to understand that it includes some types or examples such as carbon tax, sugar tax, and fuel levy, for example. E.g., we can talk about fuel levy. We can talk about we can also talk about carbon tax is quite examples that we can give in reference to this. We are saying these are typical examples that we can have when it comes to this. These are typical examples that we can give there. And then briefly describe the term subsidy on production. Briefly describe the term subsidy on production. This is a financial support or a support by government to reduce the cost of production in order to encourage production. Subsidy is government support, financial assistance, or support directed or given by government in order to promote production, in order to encourage more production from them. So this actually, it can actually done in order to influence the remuneration of factors of production, in order to encourage production, or we can say influence. We can say influence the remuneration of factors of production. Remuneration of factors of production, which we say compensation of factors of remuneration of factors of production. So supporting financial in financial form, in financial ways that government directs to companies and organizations in order to influence and encourage more production, and also influence the remuneration of factors of production. So what happens is that certain products might be encouraged to be produced. So government, in order to ensure that the companies are producing those, what it does is that it gives them some financial aid that can be in other ways to promote production of such. So why is it important for a country to prepare national account aggregate? We have mentioned sometimes previously also that a national accounts aggregate can also be prepared. For what reasons? I've been talking about this previously. Why should government prepare national accounts aggregate? It is also another form or another question that quite a lot of times students, they don't get it. We do prepare national accounts aggregate in order to determine economic activity, which we can actually do by measuring the country's GDP. One, in order to determine economic activities within a country, in order to determine economic activity within a country, by measuring GDP. GDP, for example, it can be measured. That can be done. We are saying the real domestic product, gross domestic product can be done, can be measured. We can also do that in order to measure the standard of living by also understanding our GDP, ascertaining standard of living of people. The standards of living of people can also be measured or can be evaluated through national accounts aggregate, where we take also the gross domestic product and see to it that how much production is taking place, to what level is it also meeting and reaching out to the standards of people. We also want to understand also that it can also done to compare levels of prosperity between countries. We say economic grading of countries can also be done in order to compare economic, we are saying to compare economic prosperity, economic prosperity between countries. For us to say developed countries and developing countries, it's a classification that came as a result of what? Of measuring or ascertaining the national accounts aggregate. It is actually used to compare, to grade, to rank countries in terms of their economic achievements or economic prosperity. Calculate the gross value added at basic prices in the table. Show all the calculation, the gross value added. We can also calculate the gross value added at basic prices. In this case, we are saying calculate the gross value added at basic prices, which is to calculate this A here. We want to say this A. In order to calculate it, what do? We must understand that we must add our gross value added at factor cost, and then plus the taxes on production, which also we subtract the subsidies on production. This is equals to, we are saying gross value added at factor cost. This is equal to 5,453 plus, we are saying it is plus taxes on production plus 132 minus, and then we must subtract the what with subsidies minus subsidies on production minus 12 billion rands. We are saying this, it gives us, this is equals to, this can give us 7, what is it? It gives us 573 billion. So that's how we calculate the value of gross value added at basic prices. We subtract the subsidies on production after adding the gross value added at factor cost plus taxes on production, and then we less that, it gives us AE is equals to that amount that we have got there, which is 573 billion. 573 billion is giving us that amount. And then the next question is saying, name any two features of fiscal policy. Name any two features of fiscal policy, which I was saying last time that we are talking about financial policies. We are saying what can be done in terms of this. Name any two features of fiscal policy. We are saying the fiscal policy actually, it regulates inflation, regulation of inflation, regulation, inflation regulation. But before we go to it, let me just confirm that the questions are fully answered. Okay, yeah. We need to answer question 2.4 first, and also that one, because I'm seeing that briefly discuss leading and lending and borrowing and changes in demand as measures to correct the balance of payments disequilibrium. So we are saying, in order to correct balance of payments disequilibrium, what happens here is that one changes, we are saying lending and borrowing, countries with surplus. Let's start with lending and borrowing. So what we need to understand is that countries with surplus often lend money to countries with deficit. Countries with surplus, that is to say that they often lend money to those which have got with less. That is quite true that we understand that we have had, even for example during COVID, how many billions of rands were borrowed by South Africa to from which was borrowed from developed countries and so forth. So what we need to understand is that countries with surplus often lend money to those with less. That is one thing that we need to understand. And then developing countries such as South Africa are often with deficit. They borrow money from countries with excess. Developing countries often borrow. They often borrow money from richer countries. They often borrow money from richer. They often borrow money from richer countries. And then we are saying again that in the event of some disequilibrium, member countries may borrow from the International Monetary Fund. In terms of some problems, we are saying member countries may borrow from International Monetary Fund. Member countries also they borrow from IMF. But one other thing that we need to know is that borrowing is actually a short-term solution. However, borrowing is a short-term solution. It's a short-term solution. Borrowing is naturally a short-term solution. And then I was saying the question wants you also to look at the question wants us also to look on the other part of it, which saying long demand to say that any changes in demand as measures to correct the balance of payments, changes in demand, changes in demand, changes in demand. What we need to understand is that we need to look at long-term policies that export promotion such as government incentives is usually applied in order to encourage the production of goods and services that can be exported, at the same time increasing foreign demand. Actually, the effort is to increase demand of foreign countries. So export promotion as government incentives. As government, it can also work as government incentive. Government incentive export. We are saying export promotion as part of government incentive, which is actually a mechanism that is designed to promote or to stimulate, we are saying production of goods and services, which can be exported also in order to increase demand. We can also talk about import substitution. Import substitution. Import substitution, which actually government provides incentives to produce goods locally rather than importing them, which also tries to reduce the outflow in the balance of payments. It reduces outflow in balance. It reduces outflow in balance of payments by, of course, we are saying it is actually incentives to producers to produce more by providing incentives to producers so that they can produce more. incentives are given to producers in order to produce more. We can talk about import control again, which can also be import tariffs that can also be put, and other duties and quotas which are put in place in terms of regulating demand. So what we need to understand is that this can also be defined in terms of that. This can also be defined in terms of that, which can also explain and include exchange control in terms of domestic regulations that can also allow central banks to ration foreign exchange. Central bank can also be allowed to control foreign exchange, where the earners of foreign exchange are compelled by law to hand it over to the central bank. The central bank becomes the sole custodian and control of foreign currency. So those who require foreign exchange have to apply through the central bank. So it's a mechanism that is also put in place in order to control and regulate long-term policies in demand, which is exchange control by the central bank activities. And then how the next question is saying, how can a decrease in injections impact on South African economy? We are saying injections, how can they actually impact their decrease? How can they impact on South African economy? One, it can lead to economic contraction, can lead to economic contraction can also take place there, which we are saying is reduced aggregate demand can lead to lower production. It is contraction because aggregate demand is reduced due to decrease in aggregate demand. We are saying the aggregate demand, when it decreases, it actually means that it leads to lower production and decrease in employment, and at the same time, income and employment can also be reduced, as well as production, because of decrease in aggregate demand. We can also talk about decrease in injections can also lead to lower economic growth, as aggregate demand can lead to lower investment and innovation. Economic growth can lead to lower economic growth, because we are saying reduced aggregate demand can lead to lower investment due to lower investment. It can be due to lower investment. We can say due to less in innovation and also productivity. They become limitations that need to be looked at as a result of this. And then otherwise, I would also want to mention the issue of it can also lead to higher unemployment, and businesses may reduce production and day-to-day functions, which we can also mention with reference to these points. So now, next question is saying, features of we are saying the features of fiscal policy. Fiscal policy, we are saying it is one, it is demand biased. it is demand biased. It is actually sometimes when we talk about the fiscal policy, it sometimes fail to understand or to take into account demand matters, and then it is actually influenced and based on demand, which sometimes is not clearly as checked on, and then it is actually go bound. Fiscal policy is put into place with specific parameters that needs to be checked and that needs to be achieved. For instance, we talk about the issue of maybe stimulating demand or otherwise reducing demand. So it is go bound as in terms of what is the specific intention for such implementations and practices. So it is go bound, and also it is cyclical, as to say that is something that continuously happen again and again. Fiscal policy is cyclical, as to say that it is rotational, it happens continuously. And then how can climatic conditions affect export? How can climatic conditions affect how can climatic conditions affect exports? Obviously, we are saying one, severe weather conditions like drought and maybe floods. Any other ones as heat waves can affect agricultural crops and yields and crops, leading to reduced export volumes and revenue. Severe weather conditions, e.g., we can talk about drought, we can talk about floods. They actually they affect agricultural crop yields and quality, affect agricultural yields and quality. They affect agricultural yields and quality, which can actually reduce export volumes and revenue. Reducing exports, it actually reduces export volume and revenue. Export revenue and volume is reduced because of weather conditions or severe weather conditions that can damage our agricultural yields. They affect our agricultural yields, which we need to understand that as the volumes are reduced, it means also even the yields the revenue would also be less. And then this can also cause perishable goods to be difficult in terms of to experience difficulties in transportation and storage. Severe weather conditions may have problems in transportation and storage of perishables. We have problems with perishables also, which can also reduce sales. At the end of the day, sales may be also be affected because of that. And then we are given terms of trade year one, which is index of export, index of imports, prices. So we are given year 1 and 2, and then the question is saying the balance of payments consists of a current account, capital transfer, and financial account. A deterioration in the trade balance is a result of the value of merchandise imports increasing substantially. Yes, so now the question which is there is saying, identify the account in the balance of payment that records exports and imports of goods and services. These are recorded in the what? We are saying these are recorded in the current account. It is the current account that is used to record these. They are recorded in the current account. And then name effects of international trade. Effects of international trade. We are saying the effects of international trade. This can lead to specialization because of international trade. Countries are specializing in what we call comparative advantage. We say that countries end up specializing in what they can do best. We can also talk about efficiency. International trade results in efficiency because we are saying producers are focusing and doing work in areas in ways that they can actually do the best. We can also talk about another advantage of mass production. International trade can result in mass production where goods are produced in high volumes because they need to meet the local domestic market as well as international. And then we can also finally talk about globalization. The world is a single web which has been facilitated as a result of what? As a result of international trade. We have got markets in all over the world, people buying everywhere because of that facility or because of the advantage that is there because of what to call because of international trade. And then describe the terms of trade. Terms of trade, describe the terms of trade. It's a price index that actually shows a country's export prices relative to its what? To its import. It's a price index to evaluate a country exports versus its we are saying versus its import prices. That is what we call terms of trade, a price index to evaluate, to assess a country's export versus, we are saying a country's export prices, which we say that we are looking at the country's export prices versus its import prices, which must actually be used to assess to see whether a country is having a good terms of trade, a healthy one or not. And then explain the importance of calculating terms of trade. Terms of trade, it actually can help to identify areas of economic diversification. To identify areas of economic diversification, as to say, areas that a business can be actually be able to venture into, which at the same time can boost the benefits or the imports, boost the income the country is making or is working on. It can also influence exchange rate and monetary policy decisions. It influences exchange rate. It influences exchange rate and monetary policy decisions. monetary policy decisions are also influenced through that. And then otherwise, we can also say that informing trade policy and negotiations based on calculating terms of trade helps in informing trade negotiations and decisions. Trade negotiations and decisions are also made based on understanding terms of trade to say where is the country making benefits and for what reasons can we continue to venture into some form of business that we can want to say that the country must support. So compare the terms of trade for the 2 years. Terms of trade terms of trade is equals to, we get it by index of exports is equals to index of exports over index of imports. Over index of imports. So what we are saying is that this is to say that when we are saying compare this for the 2 years, we are going to say first year one, we have to say year one is equals to, using our information on the table there, we are saying year one is equals to, we are saying year one, we say index of imports over the index of what? Of exports over imports, which is equals to say 101 over the imports 198. That is year one. Year one is 101 is equals to our 101, 102 over 98. And then we say it is supposed to be multiplied by 100. That gives us, we say 104, 104. And then year two is equals to, we have got also the figures that are given there. Year two, which is equals to our 90 over, we are saying that is also going to be 90. We are saying 90 over 100. 94 over 100. Over 100 multiplied by 100, which is gonna give us also that's gonna give us also 94. So what we need to understand is that there is a deterioration. We can say that comparing the values of year one, we are saying this is year one, this is year two. So if we look at this, we can actually say that there was a deterioration in terms of trade in year two, which may actually be due to decrease in export prices as well as increase in import prices. So the question saying assess. So as you can see, year one, we have got 104, which is good. and year 2 we have got 94. So we can actually say that there was a deterioration. There was a deterioration in terms of trade. In terms of trade in year 2, maybe due to decrease in export prices. Export prices, maybe they decreased or as well as increasing. As well as increase in import prices. So that might have caused a change, as we are seeing there, to say that there is a change. The change that we are seeing there, it might have been caused because of that. We might go to the next question again. Which is actually gonna be the 3.31 questions, the Phillips curve inflation percentage, and then we are given the change in unemployment percentage, and we are given inflation percentage. So now the question is saying, identify the economic concept at D. The economic concept at D, what we understand is that this is a natural rate of unemployment. It is a natural rate of unemployment. A natural rate of unemployment that is what you are seeing there at D, to say that unemployment is just naturally there. That is our natural rate of unemployment. And then the next question is saying, name an explanation of business cycles. Business cycles, we said that they are explained through exogenous and endogenous factors. Exogenous and also endogenous. I'm sure this we have mentioned them again before, and then briefly describe the term inflation. It is a significant in general price levels over period of time, usually a period of a year, at the expense of the current value. Inflation, a general significant increase in commodity prices. In commodity prices at the expense of current value, which we are saying that it is sometimes saying consistent or a persistent increase in commodity prices at the expense of current value. The value of money, what happens is that commodity prices, they keep on increasing, but the value of money, it keeps on falling. Instead of buying at 10 kgs, you buy it with a 20 rand. Today, tomorrow, you buy it at 50 rand, you buy it at 60. As time goes, each and every time, and And the moment there is an increase in prices of goods and services. So we call that inflation. It is called inflation, persistent increase in commodity prices, that is at the expense of currency value, which we say money can end up paying or buying less than what it should buy. And then 3.34 is say explain the relation between the relationship shown by the Philip curve. So what happens is that we are seeing that the relationship that we are seeing here, inflation and we are saying inflation versus unemployment, there is an inverse relationship. What happens there is that an inverse relationship between unemployment and inflation, which is shown there. We can see that when inflation is high, unemployment also it decreases. High inflation results in also, we are saying, low unemployment. So what we need to understand is that there is an inverse relationship. It shows an inverse relationship. Uh, there is an inverse relationship between unemployment and inflation. There is an inverse relationship between unemployment and inflation, which we can also say that as employment falls, inflation increases. As unemployment falls, inflation increases. That's what we can see from the graph. As employment falls, we are saying inflation increases. As we can see that unemployment and inflation, there is an inverse relationship between the two variables, which is shown from from our Phillips curve. It assesses inflation and employment. So now, next question is saying, suggest what government can do to shift PC to P1. PC to P1, saying government what it should do to shift PC to P1, which is to shift from PC to P1. What must the government do? It has to reduce, we are saying the government must actually reduce inflation and unemployment. To reduce inflation and unemployment, the government can improve the state of education in the country. In this case, government to reduce inflation and unemployment. It it has to actually improve the state of education. It has to improve education in the country. Education must be improved so that we can be able to have people who can work better and can be able to come up with better policies. We can talk about effective skills training. effective skills training, and also we can also talk about a relaxation of legal restrictions on small businesses. Uh, Relaxation on legal restrictions, which is applied on small businesses. Small businesses control, in terms of the control on small businesses, it must not also to be too tight. It must not be too tight, because it can also cause unemployment and inflation. So this would shift the PCP world, which we can see that it can help in the control which we are talking about. These next questions, I'm just gonna give them to you for you just to take note of them, to say, discuss full unemployment and price stability as macro objectives. So these ones are also, we are saying these are also points which actually we can maybe need to understand, to say, talking about unemployment, talking about employment, actually full employment, it refers to an increase in the production of goods and services, which we are saying that it is measured in terms of its GDP, production of goods and services. Employment can be ascertained in production of goods and services. It can be measured in terms of production of goods and services, which we are saying that it increases production of goods and services, which is measured and is measured in real GDP. It can be measured in real GDP, gross domestic product, the total production that has happened within a country over a period of a year, most importantly. So for economic growth to occur, economic growth rate must be more than population rate growth. For economic growth to occur, we must understand that to occur, the economic growth rate, economic growth rate, it has to be more than, it must be more than population growth rate. Must be more than population growth rate. Because when the population is too high, we can also not have, we can result in overpopulation, which actually can be a challenge within a country. So growth rate and development in a country benefits its people, and it often leads to high standards of living. And then price stability, price stability is another point. Price stability, it actually leads to better results in terms of job creation and economic growth. Results in term in it results in better, it actually leads to better results in terms of employment, results in better terms of job creation. better terms of job creation, which I want you to understand. It also leads to economic growth, job creation, and economic growth. So having said that, South African Reserve Bank actually targets, we are saying the South African Reserve Bank inflation target is 3 to 6%, and they have been successful in keeping within the target, which we say that again, interest rates based on repo rate are main instruments that are used to achieve the price stability, to say that the rate at which the public is borrowing from commercial banks, they must be regulated in order to stabilize the effect of inflation. So, which is also coupled with stable budget deficit, which also stabilizes the inflation rate in terms of price stability. So now I want you to understand and look at this in that broad perspective. So it also stable budget deficit can also help to stabilize inflation rate. And then lastly, I'm saying, how can business sector address unemployment in South Africa? It can actually work together in terms of education and training to develop people with the skills that are needed in jobs or in industries. So we are talking about empowerment of people with the skills and skills development and empowerment can actually help in terms of that. We can also talk about support small businesses and entrepreneurship, supporting small businesses and entrepreneurship. The entrepreneurship with financial aid. It is quite important that they also get financial aid, which can actually help them to start businesses and also integrate technology with businesses. Integration of technology with business. Integration of technology with business. Actually, it helps to increase skills and job creation. Skills and job creation can be better in that respect. We can talk about create markets for businesses to help them expand and create more job opportunities. It can also help in terms of market creation, which again it helps to boost production. It boosts production, which at the same time, when production is high, we can also have more job opportunities, which at the final end of the process, many people are employed, and then we are dealing with unemployment. Government also must also have private. We can also have public-private partnership. These partnerships also helps in terms of public-private partnerships, are also strategies that can come into play, whereby the government and the private sector work together in job creation, and also many other support functions that can be put in place. We talk about business incubation, supporting small businesses in order for them to become established, such that they can be able to become self-reliant. At that point, employment can also be created. So class, I want to appreciate your time and thank you so much for your uh, support and following Metric Hub. Keep sharing, keep subscribing, and keep joining membership. All the best. Have the best exams, and let's keep connected for term 2. It's loading. It is already there for you. Thank you.